Ever wondered how a healthcare tech giant actually scales to the moon? Today, we're breaking down the IKS Health Inventurous Knowledge Solutions Q3 FY26 earnings review. This quarter is all about one thing: unlocking massive margins through high-end tech and operational efficiency. Let's dive into the financial breakdown. Let's start with the big picture. Revenue hit 815 crore, marking a 4.3% increase quarter over quarter. But the real story is the explosive growth elsewhere. EBITDA is up over 40% year over year, and profit after tax surged 41.4% to reach 183.3 crore. Most importantly, margins expanded by 410 basis points to a staggering 34.6%. Where is this 24% year-over-year revenue coming from? It's driven by three main pillars. First, the rapid adoption of their care enablement platform. Second, a strong product mix including the Scribble Suite and RCM services. And third, an incredibly loyal client base with over 90% repeat business and new wins like StrideCare. This is where the magic happens. As revenue scales, costs aren't following the same path thanks to an AI and tech layer. By using tech-enabled delivery and cost optimization, IKS grew their EBITDA margin from 30.5% last year to 34.6% today. They're becoming more profitable as they get bigger. Don't let the headline numbers fool you. The underlying business is even stronger. While reported profit was 183.3 crore, the adjusted PAT is actually 215.4 crore. The difference is a one-time 12.7 crore non-cash write-off from debt refinancing. It's a short-term hit for long-term lower interest rates. Look at this productivity surge. EBITDA per employee jumped from 0.064 crore to 0.91 crore, a 42% increase. Despite a massive headcount of 13,350, IKS is scaling revenue without linearly increasing staff costs. This is the ultimate proof that their AI-native roadmap is working. IKS is aggressively cleaning up its debt. In just 9 months, they paid down approximately 240 crore, bringing net debt down from 562.7 crore in March to 322 crore in December. Their debt-to-equity ratio collapsed from 0.48 to a fortress-like 0.17. This balance sheet is now incredibly strong. Remember, cash is king. For the first 9 months, cash flow from operations was 667.4 crore, which is significantly higher than the reported profit of 515.6 crore. Free cash flow for Q3 alone grew nearly 80% year over year. This means they are collecting cash faster than they recognize revenue, the hallmark of high-quality earnings. Now let's talk about the foundation of the business. IKS enjoys deep integration with major U.S. health systems, boasting an average relationship length of over 6.6 years. While having 48.4% of revenue come from the top 10 clients is a concentration risk, their sticky nature makes churn very unlikely. No investment is without risk. First, that 48.4% client concentration leaves little room for error. Second, they have 100% exposure to the U.S. healthcare market, making them sensitive to policy and reimbursement changes. Finally, they face execution risk as they scale the Equity acquisition while trying to maintain these high margins. If we run a quick audit, the financials look incredibly clean. Cash flow is higher than profit, receivables are healthy with operating cash flow up 184%, and the debt profile is rapidly decreasing. Even the one-off hits are fully explained by smart refinancing. The future looks bright due to a perfect storm. U.S. physicians are seeing their own margins compressed, which is driving a massive wave of outsourcing. With their AI-native roadmap automating workflows and low debt enabling new M&A capacity, IKS is positioned perfectly to capture this tailwind. The final verdict? Constructive. Debt is down, cash is up, and margins are expanding through tech-driven moats. With a 29.8% return on equity and high earnings quality, this is a prime example of high-quality growth. If you found this earnings deep dive helpful, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.